Hello and good morning friends, welcome to the CEC-UGC live lecture. Dear friends, with another lecture on a series in management accounting. Today we would be talking on accounting framework including concepts and conventions, and for this very discussion on accounting framework we have once again with us in our studios Dr. Amarjeet Kaur. Dr. Amarjeet Kaur is a professor of accounting and she is the dean of a management school. She has taught in USA University and she is a certified management accountant. So dear friends, we believe that she is the most appropriate person to talk on management accounting. So without wasting any time, I would like to welcome our guest Dr. Amarjeet Kaur, and let's try to understand more and more about accounting framework. Hello ma'am, welcome to the EduSec lecture.
Thank you Gitika. Very good morning to all listeners. This is the third module we are going to cover today, and the topic and agenda of today's talk is accounting framework including concepts and conventions. In the last two modules we talked about management accounting, cost accounting and financial accounting, three branches of accounting. And today I am taking the discussion further to understand that how does financial accounting works. You would be surprised that though the subject I am covering is management accounting, then why I am intending to talk about financial accounting. So this must be a question in your mind. So just to clarify that, when we discussed in the last lecture that management accounting regenerates information by mending whatever is there in financial statements. Right? So by regrouping, by working on the information, we regenerate some useful information for management, for managerial functions. So when I say that we regroup the information, we remend the information or regenerate the information, we use certain tools which we discussed that by analyzing financial statements, we get a very concise and precise information for decision making to be useful in management accounting. So this is the background. So while analyzing, we use certain tools, ratio analysis, cash flow, fund flow, which we mentioned in the last class. So referring to that, when I'm saying we have to analyze financial statements, means we should have some basic knowledge or information about how do we create financial statements. Right? How does this procedure happens or takes place or works in financial statements? That is why we need to talk about the framework behind financial statements. How are they written? Is there any guiding rule to write financial statements or not? Because the primary source of information for management accounting is what we get in financial accounting. And that is why today I am targeting to talk about the framework which guides us to write financial statements. So I hope background this is clear to you, that why we are targeting to address concepts, conventions and the framework of financial accounting while talking about management accounting. So moving forward, let's have a look at this slide. The slide in front of you shows that what is the origin of financial statement. How does we generate financial statements? If you refer to these three boxes there, first box is on transactions, and then the last third box is on financial statements. In between, the middle box that refers to the procedures we have. So business transaction is the beginning point of preparation of financial statements. Let's take some good example. Let's say you started a business in any area you like to. You can assume, you are free to make any assumption here. So let's say you started dealing with machinery, procuring some machinery, equipments, etc. in solar energy, say from a company in German, and you are selling that machinery here in India to different people you are going to be user of that particular machinery. So the point is, you are procuring it and you are selling it. This is one thing. when you are doing this, you are paying for your email bills, your telephone bills, employees who are generating the information for you, that who are the sellers, who are the prospective buyers for your products. So the marketing people, I may say, there are people who are keeping the record for you. So accountant, you may be hiring someone as CA to keep record of your transactions and all. So what is happening? Assets are the things, or the inventory for you is what the machinery you are buying for, say from Germany, the solar panel system or any other machinery, right? So if you are buying it from Germany and then you are procuring it and then holding it in your warehouse, say, and then you are a couple of people whom you are paying salaries and wages. There are a couple of people who may be supporting staff to you. You may be using some office anywhere in Delhi, anywhere around, wherever your office is based in. You may be paying rent for the office, or you may be having the ownership on that premises. You may be using a laptop, a system, a furniture, table, chair, etc., etc. So this is what precisely is required when we are into a trading business. I am taking an example of trading business where you are procuring somewhere and reselling it, right, for some use. Now, how many transactions have taken place in this small example? A very small example I took. Buying of machinery, buying of furniture, buying of laptop, telephone, and handset, hiring a man for marketing, a person for marketing, hiring someone for generating, information, looking for quotations, looking for tenders, looking for, So what is this? They all are business transactions, right? Now, how would you know you are making money out of this business or not? You are making some loss or you are progressing. How many assets do you have after some time of working? How many people you owe to? The liabilities, right? So these are the questions which needed to be answered to you if you are an owner of a business, right? A trader, or maybe someone who is just a consultant, a scientist. A scientist could be a consultant in this particular field, right? So the question is, so many transactions taking place, and we as an owner of the business want to know that what is the outcome of all my activities which I pursued during a particular time period, maybe a year, right, that we call as financial year. So if I as an owner want to know the outcome of my efforts which I carried, and the status of assets and liability I have, or a status of the cash I have, status of debtors and creditors, all I have, what do I need to do? I need to process all transactions which I just quoted in this one example, right? That processing of transactions is basically known as accounting process, right? And that accounting process gives us the output which we call as financial statements. So I hope you are with me that transactions are the basic input for financial accounting system which generates financial statements, right? And the transactions go through a procedure, a process, and there is some guiding rule which help us to decide how to write about all the transactions I just quoted in the example, right? And that is the agenda for the day. So that is what I want to talk today, the framework, the guiding rule for the day, right? So if you refer to the same diagram here, there are two words in the middle box highlighted: bookkeeping and accounting. So bookkeeping is basically when we simply decide or sort out these business transactions and put them into certain groups. So that is what is known as classifying. So for example, out of few statements I made in the same example, I talked about procuring of the machinery which you are going to sell. So that becomes your inventory. Maybe a solar plant, maybe a laser technology, instrument, equipment, or maybe some other equipment. So that is inventory for you. That becomes an asset for the business. Then you have procured furniture as well. Again, that is an asset, but that is not meant for selling. That asset is meant for using in the business operations. You procured a telephone, you procured a laptop, and hence and maybe a book, a Kindle, or any other book, so that you could use them in your business operations, right? So they all are basically assets to you. They form one group. So putting all the transaction of similar nature, all the variables which are dilated in the business transactions of similar nature, and putting them together is known as grouping or classifying. So accounting process up to this step is known as bookkeeping. And the second highlighted word in red color was accounting. So when after this point, when we have already classified, when we move further and we want to actually analyze and interpret the information so that other people who are interested in this information, financial information, could use it for decision making, that is what is known as accounting. So there's a difference in bookkeeping and accounting to the extent that bookkeeping emphasizes on only putting the data into books and classifying, whereas accounting goes further and analyzes as well as interprets the financial data. So this is the background. Now, why are we actually writing these books? There could be number of reasons to write the books. We have some compliance requirement. Companies Act in India requires, SEBI requires, income tax guys, they want you to have your statements written so that you could decide how much tax you have to pay. So compliance could be one thing. There could be another reason that we want to provide the information to the users in terms of who are providing us credit. So financial institutions, banking institutions who are giving us loan, overdraft facility, etc. There could be a possibility that we want to generate the data so that labor unions could use that. If we are a big organization and we have plenty of people working for us, good number of people working for us, then the labor unions could be the prospective users of the information. Not only that, if companies are owned by someone else and run by someone else, it means there's a difference between owners and management. Even then, we need to have financial statements for the purpose of using to be used by owners, because stakeholders are different than the managers. If companies is very big in size and owners are sitting at some far away place and management is just on higher term or the salaried people, so again they are the users. There could be number of people, the policy guy, the government who have to make policies about a particular zone. How do we decide that this should be SEZ zone in India? How do we decide we should be giving some kind of special tax rebate to a particular industry? So based on the data available for the companies working in that particular industry. So that's how a business runs. That's how an economy runs. So these financial statements gives us financial data or financial information. You may call it as economic data as well, which helps us to make so many policies to help us run the economy effectively, smoothly. And that is why we have to ensure the information which is generated by financial statements is basically very useful to the users, to the intending users of the information. So what do you think? What should be there in that information that it is useful to all the parties I just took as an example, intended users of the information? So I'm sure you may have few answers, but prior to that, let's have a look at the slide here on the screen, which says, financial statements, what all required disclosures and what all information is available in a particular statement, a financial statement. So if you refer on the left hand side, the title says required disclosure, and the right hand side says financial statements that satisfies the requirement. So if I want to know the financial position at the end of an accounting year, financial position in terms of assets, liabilities and the capital, three things: financial assets and liabilities more importantly. Then we refer to the statement which is known as balance sheet. The second required information is about how much did we earn, how much we earn or maybe we lost in a particular year. For that we refer to income statement, or we may call it as a statement of profit or loss. Third information is required about how much cash has been generated during a particular year or period, and that information comes from statement of cash flow. And lastly, if we want to know the investments made by the owners or withdrawals made by the owners, and that comes from a statement of changes in owners' equity. So these are the four major sources of information. They are called as financial statements. Other than that, we may have footnotes, we may have policy declarations, we may have management discussion session at the end of the financial statements. But one important thing I want to mention is this, that in India, financial statements comprises primarily balance sheet and income statement, which is now called as statement of profit and loss, and cash flow statement is not mandatory for all businesses. Preparation of cash flow is mandatory only for those companies which are listed in the stock exchange, and also for other companies which have more than 50 crore of turnover in a particular year. For that particular year, a company will have to prepare income statement, balance sheet as well as the cash flow statement. But if we compare this particular rule with other countries of the world, especially for example US, where I happen to teach in two universities there, preparation of cash flow statement is mandatory for all companies. So this is one big difference in Indian practices and US practices, for example. But in India, yes, first two statements are mandatory for all companies, irrespective of either they are listed or not, or the amount of, or whatever the amount of turnover they have for a year. So moving forward, now we will talk about, with all this background, now I want to talk about what is accounting framework and what is the genesis of this framework. So accounting framework is basically a set of rules which helps us to write the books of accounts. And the genesis of the accounting framework is something I am going to discuss first, followed by who are all or why do we require accounting framework. So moving forward, we will be talking now about the genesis of accounting framework. As I just referred, that accounting information is not only used by the owners of a company. In fact, a financial accounting is of more useful to the external parties which I just mentioned, whether it is a banker or any loan institution providing you loan, labor union, your employees, or maybe even government. But management accounting is something which is more for insiders, for management. So as I said, the genesis of this accounting framework is based on that we have to provide financial information to all the intending users of the financial information. So there are certain reasons why the accounting framework came into existence. So accounting framework means the set of rules. So the first reason that why accounting framework has been into existence is that the ownership and the management are two separate entities. So in most of the businesses which are of operating at a very large scale, this is true. that owners are separated from the managers or management. People who just promoted a company, they just move away, and the companies are finally run by the hired people, by the management who have been paid actually. So in that case, it becomes important that owners could know that how my managers, how the management, though which has been appointed by us only as owners, how are they doing, how are they performing in terms of generating cash for the business, generating profit for the business. So because of this reason, that the information which is provided by financial statement should be reliable for owners to think that the managers are doing work or carrying the business operations in the best of their interest. So that is why we need to have an accounting framework in place. The second reason is that dependence on lending institution. This dependence on lending institution is basically increasing day by day. There were the days, maybe a few decades ago, when people were hesitant in borrowing loan. People were not of the belief to borrow and then invest in business. But nowadays, this ideology has changed completely. Now people believe if we are having such an idea where we can get sponsors for our idea, people who can come as angel provider or angel funding provider or otherwise. So then we are the genius ones, that we have such an idea which is being which can be actually bought by someone and can be funded completely. So the ideology has changed. Now people believe that the best businesses are the ones which can be run with the help of outsiders funds. So because of it means, so the money invested in a business could be purely of someone else, and business can be run by someone else. So because of this difference, that who is running and who is basically owning the business is entirely different. So that makes a compulsion that we have a set of rules in accounting, so that the information generated by books of accounts is reliable by the people who have put their money on stake by buying your idea, right? Now moving forward, there's another reason, that the legal intervention, the Companies Act, the IRDA, SEBI, Income Tax Authority, so they all are in place. So because of this compulsion, the legal intervention, it has become kind of mandatory that we have some guiding rule to help us writing the books. Then the complex financial instruments are there. That's another reason that we require a accounting framework. There were days when only we used to know saving accounts, current account, or just recurring account, few limited instruments in terms of shares or debentures investment. But nowadays you will know that there are hundreds of thousands of new financial instruments. We can lend someone, we can lend something, we can get something refinanced and then refinance. Securitization is possible. So many new financial instruments are emerging every day because of the globalization and all. So that requires we have very well defined accounting framework and set of rules to be able to find out the actual assets and liabilities of a business. Moving forward, another reason is that we have institutional investors more than individual investors in a business, because what happens, if you refer to maybe 200 ago, for example, Tatas, they brought their first company in 1877, the spinning mill in Bombay, when Jamshedji Tata established this company. So there were hardly anyone to provide loan to the business that time. Even in the second time when he brought up Tisco in 1905, first steel plant by an Indian. So even then there was hardly any financial institution to provide loan. but nowadays there are institutional investors more than individual investors. Banks to whom we put our money as fixed deposit or saving deposit, they invest further for other businesses. Insurance companies to whom we pay a lot of premium for our safety, of course, annually or in any mode, even they lend our money to some other business. So they become as institutional investors. So institutional investors, they invest huge. They don't invest in hundreds or thousands. Of course, they invest in hundreds and thousands of millions of dollars or rupees, right? So they need to know, they want to know how well a business is doing, and they want that whatever is presented in financial statements is reliable. So that is why we need to have an accounting framework in place. And lastly, a very important thing, now we are living in a globalized world, in a global village, in fact. So we may have investors who are coming from other countries in the form of direct investment. We call it as FDI, foreign direct investment, maybe FII. So in any form. So even then, it becomes important that our financial statements are such that those people who intend to invest in a business running anywhere in the world or so is reliable, and they could get a fair picture of the status of assets, liabilities, revenues, expenses, earnings, etc. And for that, a framework is needed. Last thing in this module I would like to talk is that the purpose of framework. So the discussion would be enough for you to understand that why do we need to have a framework in place. Precisely, we can say there are four users for whom we need to have the this framework well in place. One is preparers, people who write the accounting books. For example, an accountant in your company, in your business, he would need to know the guiding rules, a framework to helping in situations where we do not have accounting standards. He may come across a situation which is just a new one, which has never been existing before. So he would need to know how to write a book or convert the transaction into statements when he faces that situation. Then auditors, the people who have to audit the financial statements, they are the ones who have to make and form the opinion about the financial statements. How fair the financial statements are to present a true picture of the business operations. Then we have other users in terms of banking institutions, government, who are not directly involved with the business but outsiders, which we just discussed few minutes ago. And then lastly, we have accounting standard board. Accounting standard board is a board which actually establishes standards, is a body associated with ICAI, Institute of Chartered Accountant of India in India. And this board develops, reviews accounting standards. So this board reviews the existing accounting standards and works on developing the future accounting standards. Accounting standards are not static in nature, they are dynamic. They need to be reviewed, relooked and rechanged, and always. So we need to revisit them quite often. So this is the fourth user group, or this is the reason that we have to have accounting framework in place to help us writing accounting statements effectively, so that the information which we generate through financial statement is meaningful to the users. By this, we will end this module. Thank you to you all. Welcome back. Good afternoon to all those who just have joined us. We are going to begin with module 4, and this module is on accounting concepts and convention. The agenda for next few minutes is that we want to talk about the concepts and the conventions which help us writing accounting books. The background is GAAP. You know, if you refer to this slide, this reads GAAP, we call it as GAAP, which is known as Generally Accepted Accounting Principles. So what they are? So let's spend few minutes to discuss the need for GAAP, and then we will talk precisely about each existing concept and convention in the accounting framework in India. Generally accepted accounting principles are basically the building blocks for us to help us writing the books, you know, to the best possible way, so that the information is generated in a very meaningful and effective manner. So, since financial accounting is a branch of accounting which communicates to the rest of the world, right, about the financial, data of the business. So I hope you could get my statement right. I'm saying that this branch of accounting helps us to communicate to the interested people, right, about the outcome of our business operations, whether it is in terms of how much inventory do we have, how much assets we have in terms of cash, in terms of furniture, in terms of stocks of other companies, or in terms of how many liabilities do we have, or maybe even how much profit we earned from business operations or from other sources. So whatever may be the purpose, but this branch of accounting helps us communicating this information to the users, to the people who wants to use the information. So these accounting principles are known as generally accepted accounting principles, help us writing the books so that we communicate the exact or the best possible information to the users of the information. Moving forward, these gaps basically are comprising two things in it. One is concepts, another is conventions. So concepts are basically principles which have been decided, which have which have become principles, but they were initially theoretical assumptions. Accounting is not a very old discipline. It is just few hundred years only old. So when we started with this discipline, few assumptions were made. Then we re-looked into those assumptions. Then we changed the assumptions, and some new theory developed. And this is how any discipline would develop and grow. So that's the same thing has happened in accounting as well. This, when I say accounting concept, means the theories or the assumptions which are accepted by any accounting body. So that's what forms as concepts, right? So concepts means assumptions, if you want to define it, assumptions which are accepted widely by the accounting body or some government body. And they becomes the basic, parameter, or rather I should say a guiding force, which helps an accountant to write the accounting books or books of accounts. So the first concept or the first, theory I may say, or the first assumption here I am going to discuss is accounting entity concept. Now, as per this concept, we believe this. That this business entity and the owners of the business are two separate entities. So what does it mean? We took an example just few minutes ago in a previous lecture on module 3. We were talking about a company. Say for example, the name of the company is Scientific Solutions. private limited maybe, or public limited. So I'm just assuming one name, and then the owner could be XYZ, right? That owner is different from the business entity. This is the first assumption we made before we write the books. It means, so what is the repercussion? What is the consequence of this assumption? Let's take it further for the sake of understanding. Let's say owner brought in, when he started business, say in 1999, the owner of the business, Scientific Solution Private Limited, he brought in say 10 lakhs rupees in 1999. I'm just assuming, right? So that 10 lakh is something which was brought in by the owner. That was his personal money. Maybe he brought it from his father, maybe he bought it from his friend, or just brought in the money, or his savings from the previous work, right? Now the business is a private company. It could be a firm even. So the business is a separate entity, means this 10 lakhs rupees which were brought in as capital by the owner of the company, that amount needed to be paid back to the owner by the business. So it means we cannot say that money is of business, belongs to business. No, that money belongs to owner until he gave it to the business. Once business takes it, it becomes the capital for the business, right? But it is supposed to be paid back. So that is why we consider capital as a liability of a business towards the owner. I hope you understand. We can understand it further by the same example. If the same owner, say for example, withdraws 2 lakhs rupees to pay fees for his daughter, right? So what happens? He withdrew 1.5 lakh, 2 lakhs, 3 lakhs, whatever amount, and he paid for his children's daughter, or his children's education fees, college fees, school fees, whatever. So what is happening now? So now owners owes to business that 1.5 lakhs to pay back. This is the outcome of this assumption. So it means owners' events or activities are separate than that of our business. So that is why we write capital as a liability in our books, and we write withdrawals, as a liability of an owner to pay back to business. That becomes an asset, in fact, for a business. Though this is there's something more than this. It's not as simple as I'm talking, but yes, to understand this concept, this example is enough. So we treat accounting entity as a separate entity than an individual or a group of people who started the business. And that is why profit belongs to, profit is a liability for the business. Mind you, I am saying liability, not asset. I know 80% of the people who even pass out after doing commerce, BCom or BBA or even MBAs, even they take profit as an asset. So you just question yourself, were you right or you wrong when you assumed that profits are assets? No. Profits are liabilities for our business. Why? Because business use the capital invested by owners, and business is supposed to pay back it to owners. So it becomes a liability of a business to pay back to owners. So that's why, so this is the first and foremost assumption we have in the accounting standards, that owners are a different entity than a business entity. So Scientific Solution, which I took an example, is different than the owner of that particular business. Moving forward, let's take the second concept, and we assume going concern concept. So what does this concept say, and what is the interpretation, and as well as the influence on our books of accounts? So this going concern concept says that we cannot assume a business will be liquidating in a short while in future, right? We assume that business will keep on going for long, and it is not going to be liquidating. Why did we assume it? What is the purpose of assuming such or making such assumption, as concept is an assumption, as I said. So an assumption is helping us to write our books better so that our results are effective. There's a consistency in our information we are generating. There's a reliability in the information we are generating. So the reason is, when we are assuming a going concern concept, that business will keep on going, we are trying to avoid to not take into consideration any such thing which has not happened but which we know is very, very certain. So we cannot record any transaction in our books of accounts, by assuming that by assuming that it will happen soon. No, because this concept says we are assuming business will keep on going. This is an assumption, and we should be recording a transaction in our books only when it happens. So if you take an example, for example, you bought a piece of land for your office in Malviya Nagar in Delhi in 1999 when you started your company, and you paid maybe 20 lakhs for that office, right? And the value of that office today, the market value of that office today is say 1 crore, right? A huge appreciation, isn't it? And your books have recorded it as 20 lakhs rupees at the time when you procure it. Now, we cannot record the difference of 80 lakhs in our books unless we sell this office in actual, right? I hope you all understand what I'm trying to bring out. So we are assuming a business will keep on going, and we cannot record anything, though could be very certain, unless it happens. So this is basically, this helps us to avoid not to mispresent the business data, mispresent financial data. So that is the objective of having this concept in place. The third concept I want to talk is money measurement concept. As per this concept, we are required to record only those business transactions which can be measured in any monetary unit. That monetary unit could be a rupee, in India. In US context, it could be dollar. In Britain, it could be pound, or any currency you may refer to. So the point I am trying to make, this is an assumption in accounting that all business transactions would be recorded only in quantitative form, precisely in monetary units only. Just to illustrate, I can say, you cannot say that I have one office in Malviya Nagar. You cannot say I have one office in CP in Delhi. I have one office in Jaipur. No, you have to say I have two offices. One is in Delhi worth 1 crore. I have another office, so two buildings are owned by the business, and the value of the two buildings is 1 crore in Gurgaon, 1 crore in Delhi, or maybe some other place as well. So we have to quantify and have to present that data in monetary unit. So this is the foremost assumption. That is why you will see that all financial statements, they just give the data in either rupees if we are referring to an Indian company's statement, or if you are referring to some other country, that it would be in the currency of that particular country. The next concept I would like to talk is cost concept. Now this cost concept is basically correlated with going concern concept. The concept just above that cost concept was the going concern concept in this slide which we just referred now. So they are both correlated even. In fact, all the assumptions are not independent. They are integrated. They are dependent upon each other. As I said, they evolved. So we would have made one assumption, and then we would have developed the second assumption, a concept. So that is how they are evolved, and that is why I am saying they are integrated, because they evolved gradually and they are based on each other. So this cost concept, the fourth concept which I am talking right away, is this, that we assume in this business writing that we would be recording all fixed assets, that long-term assets, on the cost price, not on the market price, right? So cost price means the price which we paid for and also the price which we paid for to bring the asset into use. So, to explain it further, let me take some good example. We just referred to Scientific Solution Private Limited. If the Scientific Solution, bought some solar plant from Germany, say, and the price of the plant was 1 million euros, right? And they spent 10,000 euros on transportation to bring the plant from Germany here in India, and they also spend maybe 5,000 euros to install that plant for someone to bring it to use for their company, say. So how much did we spend? 1 lakh euros, 10,000 euros on transportation, 5,000 euros on installation, and maybe 1,000 euros for wages as well, or you may say to some consultant. We want to know the drawings where we have to install that plant. So in all we spend 1,16,000, right, to bring that asset into use. So how much would be the value at which we would be recording that plant into our books? We own that plant. Say we own for we purchase it for our own company, for our own use, right? So I will not record in my books only at 1 lakh which I paid as purchase price. Sorry, not. We will be including the transportation, because without transportation that plant could not have been brought here in India. Without insurance we would not have brought it in here. Without installation we cannot take the plant into use. So all that money which we spend on any plant and machinery, on their purchase price, on their transportation, on their installation, consultancy, etc., so that we could finally use the machinery or the plant into our business use, becomes cost, right? The cost to be recorded in our books. So that is the assumption that all assets which will be purchased in a particular year, say plant was purchased in 2010. So in 2010 we will be recording this plant at 1,16,000 euro, converted into Indian rupee of course at that point of time, and we will be recording in our books. Now after that this plant is a fixed asset, is subject to be depreciation, to be charged depreciation on the plant. The amount of depreciation would be calculated on the total cost price which we recorded in our books. So I hope you are clear with this concept, which says record all assets at the cost price, not at the market price. There's a possibility you just paid for $1 million or euros on today, which was the year you purchased on that, and immediately next day the price was maybe 120 times more, maybe just 30% of what you paid for. There could be sudden policy change, and the price may have just gone down half, or may have gone up twice, right? So we cannot consider anything than what we actually spent on, including the uses part, to bring it into use. So moving forward, the fifth concept I would like to talk is objectivity, the concept of objectivity. As per this concept, we say that all books should be written objectively based on all the guiding rules we have in this regard, and there should not be any subjectivity of whatsoever kind while writing the books of account. This is a very, very simple assumption, but is important for having an effective financial information available in financial statements. The next is accounting period concept. This accounting period concept is related to the ongoing concept. In ongoing concept, we assumed that business will keep on going. It will not liquidate very soon. That's what we assumed, right? So when we are assuming the business will keep on going, the next question comes in: when will we come to know about the profit or loss we made about from our transactions, or what is the value of assets or liabilities we have in the business? So to get the answer to these questions, so it's essential that we make some further assumption like this, which I am just talking here, accounting period. So accounting period concept is not a difficult one. It says that since we assume business will keep on going forever and we don't foresee any liquidation in near future, the next assumption is we need to divide that defined life of business into certain accounting periods so that we could find out the status of assets, liability, which we call as financial position. So we could know the status of financial position as well as operating results for any business for that particular period. So the life is divided into a period of 12 months each. So one accounting period is known as a period comprising 12 months. In India, we begin this accounting period on 1st of April every year and end on 31st March, whereas in US and another couple of countries, it begins on January 1st and ends on 31st December. So this is what is known as accounting period. It means our profit or loss is calculated for a 12 months period beginning from 1st April every year lasting at 31st March and so is for balance sheet items. Moving forward, the next is matching concept. Matching concept is basically important and is related to when we talk about accounting period concept. Matching concept says that we match two items to find out profit or loss for a business. So what are those two items? A very objective of writing or making financial statements is that we want to know how much profit did we earn in a particular year, right? Or maybe how much loss we incurred in a particular year. So how do we calculate that amount? So anyone who is either ever has studied accounting or not would be able to understand, or is running the business would be able to make out very easily that profit is the difference of revenue we generate from selling of services or goods and the expenses we spend on generating that revenue. It means the difference of revenue and expenses, these two variables, the difference of these two variables gives you a value which is either a profit or loss figure for a business in one accounting period. So when would it be a profit? Well, very simple, when your when your revenue exceeds expenses, it is your profit, and when your expenses exceed revenue, it is your loss. So this is the operational result. But matching concept goes further. It says we should be matching expenses of one accounting period with the expenses of the same accounting period. What does it mean? It is something very, very tricky and a little difficult as well. It means, let's take some example. Say a business sold some product in the month of April, or say March. On 5th of March, a business has happened to sell something, and business closes its books say in India if it is 31st March. So you sold something in the first week of March, you are closing your books on 31st of March. So let's say you sold for $10,000, 10,000 euros. So your sales are for 10,000 euros and you are closing your books on 31st March. But you did not pay, you did not pay for the wages or for the salaries of the people who have helped you generating that revenue, who helped you to get that order. They were working for you in the month of March. They worked. You could get the order from because of their efforts, but you have yet to pay them because the policy or a practice in your company is that you pay every 5th of next month. Right? So you pay every 5th of next month. What does it mean? You are not going to match the expenses which would be paid, of course, in the next financial year, because it will be April 5 by the time you pay them. So should you be matching those expenses next year? No. You should be matching those expenses of salaries, which help you generate that revenue of 10,000 in the month of March, in the month of March only, not in the month of April. So we would be matching the expenses of a particular accounting period with that revenue of the same accounting period. That is what I am trying to bring out. The last concept I want to talk is accrual accounting. Is the most important concept in accounting. The whole accounting system, the current accounting system is based on that concept. That concept says that if I take the same example, just the same example, you sold a machine for 10,000 in the month of March, right? So let's assume you sold it, but you did not get the cash. The cash is paid in after 60 days. You sold it for 2 months of credit, right? So the question is, should you be considering this revenue for the month of March in the last financial year, or you will take it in the next financial year? So accrual accounting says, irrespective you paid for your expenses or irrespective you received the revenue, we are going to record the revenue and expenses both in an accounting year in which it actually took place, irrespective cash made or not, cash paid or not, right? So this example I believe is a good one to help you understand that accrual accounting emphasizes on recording the concept on recording the transactions in business based on their happening, not on based on the actual payment are made or received. The last thing, as I said, we will be talking about conventions as well, and we have just 2-3 minutes in hand. So accounting, there are 4 of the accounting conventions. Concepts we are done with. The 4 conventions are basically, one is full disclosure, consistency, conservatism and materiality. So let's quickly discuss on 4 of them. When I say full disclosure, so first of all, let's understand what conventions are. Concepts, as I said, are assumptions, whereas conventions are rules made out of practice for the sake of convenience, for the sake of bringing more clarity. So they are not as hard as concepts are. Our books are written very much as per the concepts, whereas conventions give us some flexibility. So there could be some businesses which may be following the conventions. There could be some other business which may not be following the conventions. So the first convention, as I said, is full disclosures. It says all businesses should disclose the all relevant information in financial statements. So it is required. So as I said, it's not there could be a businesses which may not be doing it completely, but it is though required. It is required that we should be disclosing every important information which is material. The second is conservatism. This convention says that we cannot be liberal in writing or in taking into consideration anything which has not happened yet. Say the example I took few minutes ago, the building, the office which was purchased in Malviya Nagar for 20 lakhs has value of 1 crore today. So 80 lakhs is something you would earn if you sell off the office today, but you cannot take this 80 lakhs into your books, consider, because you need to be conservative here. Whereas in case you see you have sold to someone, you say he may not be paying you, you can create a provision. So the application of this particular convention is that we create provisions in our books based on the concept or convention of conservatism. So we need to be conservative in our approach while dealing with unearned profits, and we should be providing for unseen losses which we expect may happen. So that is the application of this convention. Then consistency says we should be following the same accounting rules for writing our books over years and years. We should not be changing our rules of writing books without any very particular or a solid reason. The last convention says the materiality. It says, as per this convention, we should be recording all those information in our books of account if they are material. If the cost of writing a particular information in books of account is more than the benefit we expect, then it is immaterial. Say for example, 100% of the businesses today will have a stapler in the business. Last example I am taking, right? So stapler, as per the definition of a fixed asset, is a fixed asset because it serves for more than 12 months. So we consider a stapler as a long-term asset, a fixed asset. But the cost of stapler could be just a 50 rupees. And fixed assets, are subject to depreciation as per accounting rules. But we exclude stapler considering this convention of materiality, because if we will decide to write off stapler for depreciation, the cost of preparing a particular account for stapler would be more. Keeping the record for 10 years, 7 years it lasts would be more than the benefit we get. So because of this particular convention in place, we refuse to record stapler, a punching machine, as fixed asset in our books, though by definition they are fixed assets. So these are all concepts and conventions basically known as generally accepted accounting principles, which help us writing our books more effectively, so that the information generated is useful. I hope you all could get this well.
With this note, thank you, ma'am. Thank you so very much for giving us a very productive session.
Thank you, Kritika. Thank you to you all.